Futures point to a slightly positive open on more European headlines. Economic data on tap includes housing starts and U.S. industrial production. FOMC minutes will be released as retail earnings continue. I'm Taylor Schrantz, and the morning call starts right now.
Good morning. I'm Scott Rudler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with The Street, and together we bring you the morning call. Scott, we've had a really unconstructive grind down, just like we had an unconstructive grind up. As we know, it's always easier to trade a bullish market versus a more bearish market when we're looking at corrections and having that conversation. So let's go through the week. How are we looking?
I think at this point we're still looking at headlines. We're still getting gyrations on every news release out of Greece. The problem is that we're not at these extreme levels yet. So this grind lower, it actually has to happen. We're still only about 6 to maybe 6.5% off the highs. And if you think about the news out there out of Europe, and you think about some of even our data that's been slowing a little bit, why not trade 7 to 10% off the highs? But in that process, it's always painful if it's slow and grindy. That's why traders at this point are looking for some type of acceleration, some type of fear. So maybe we could actually trade from the long side for more than just a few hours.
So we have like a couple key levels that we're looking at today, but we almost need like the S&Ps to be down 10, 20 handles to really get that reversal like you were talking about before. So are we buying here, or are we just waiting to see how this situation plays out with Greece, with Europe, with the regimes that we have there now?
I think guys are taking a tactical approach. So recently pivots have been working. So if we take a look at the chart of the S&P, you'll see that we have yesterday's low now. You have a macro pattern in place here. You have this left shoulder, you have the head, you have the right shoulder. This was your tactical way out around 1390 when we broke this level. This was the day that we had our big jobs Friday, and we sold it. And then once we broke this neckline here, which was around 1360, that gave us a pattern that measured the distance all the way down from 1420 to 1360 to 1360 down to 130. So at this point you have to take trades along the way. So I'm watching yesterday's low. Yesterday's low, let's use the spiders because a lot of guys trade it. That's 133.13. You could be long against that, but I do think for us to get a real low, we have to trade through 133.13. We have to go down like $1.50. We have to fall 10, 15 handles and then come back up, create some type of tail bottom, and then we could work off the oversold condition. But with the futures up 2 handles today, I don't think that's going to do anything for the composure of this market.
Right. I mean, we need the volatility. We need the volume to come back in order to make it a tradable market. It's been really frustrating for everybody out there. We're going to jump into the sectors and look at key themes within the market, because even though it's been unconstructive, our job is to tell you what to take a look at. If 2:30 yesterday, and one day is not a trend make, but when the market, just before it fell off, the sectors that were notably up were tech, the financials, and consumer discretionary, and that has been the trend this year. So Scott, let's kick it off with the Qs and take a look how that performed yesterday.
Well, the Qs have been also grinding lower, and they've given us some clues that we have further downside. So if you recall, about 2 weeks ago when the market looked okay, we were being led by the Dow. We weren't being led by NASDAQ. We weren't being led by the Russell. So that gave us some clues. Don't fall asleep here. We could roll over. So if you look here at the Qs, you will see that, remember this descending channel to the downside? The Qs made a lower high versus area when the Dow was trying to break out. That said, be careful. So anyway, we came in pretty hard. We're right now on the 100-day. So I think same type of scenario as the spiders. Watch yesterday's low, 63.26. Use this as a pivot. If we were to break below this low, I think a lot of guys will get stopped out that were using the 100-day. And if you see a quick move down, some type of fear type move, and if we come back up through that low, that could be a tradable pivot. So at least you could buy that area with the plan versus the low. And really buying pivots or buying, once you trade through the pivot, put the low in, buying versus that pivot has been creating cash flow, but unfortunately you can't stay with it because we've been still in this monotonous down move.
Right. Speaking of the Russell, we're going to take a look at IWN, and I was not aware of this. I thought tech would be the most heavily weighted, but David Peltier stocks under 10 pointed out the financials actually are the biggest component of the Russell.
It's interesting because the Russell itself has also been lagging. In a healthy environment, tech, the Russell, they usually lead. So at this point, if you look here, we're trying to maintain and we're trying to hold this key level of support. I talked about this earlier in the week. I talked about 77.97. We're now below it, but if you look, we're not like cascading below it. We're not getting crushed below it. We're just like inching below it, which is tough for people who are trying to buy a dip and also tough for people trying to be short. So this pattern really, though, if you look at it, it's a very messy head and shoulders pattern also, where you have a left shoulder, the head, the right shoulder. If this pattern triggers and we really get below the 77.91, you actually could see the measured move there, I think, is about 4 points, and that brings you down to about 74 on the Russell, which would then bring you below the 200-day. So, if we trade below this, that's your line in the sand, that's your don't pass line, that's your point of pivot.
Moving along to gold, ticker GLD. One noticeable thing this year, going from 1,800 to 1,600 and below. Gold and silver, for that matter, SLV, have been trading noticeably lower than the rest of the market.
Well, gold lost its identity. I don't
Right.
think
Have
people,
the fundamentals really changed, though? I mean,
I think that people like to say it's an inflation trade, like to say it's a fear trade, like to say it's a currency trade. And when I traded gold, it had an identity, and it actually had a fundamental and a technical reason. Lately, it's been just trading from pure technicals, and it's been trapped in a downtrend. If you look here, if you follow technicals way back when, look at this outside day. This was your outside day way back when. That was your point to sell it. That was okay, let's see what happens from there. Since then, it's been in a downtrend. If you guys remember that Fed day, look at this harsh down move. This was the day that I think people said the Fed will be doing not much more QE, and this re-energized the down move. And since then, look at this downtrend also. I know I tried playing along a few times for it to break it, but it didn't. And finally, this pennant type pattern here broke to the downside, but today is interesting because you do have a major pivot. Anytime you have a major pivot, you have some action. The low here is 148.27. Yesterday it closed in the dead lows. It's down today. I would say, if you're short gold, congratulations, you just caught yourself a nice move. I would say cover some. Cover a little bit into this area. I think traders might even look that if we reclaim yesterday's low of 149.63, they might try and play an oversold bounce to fill this gap, which is what's been working tactically. But overall, I just got to show you the monthly chart. Monthly chart's a little dangerous here. Look at this pennant up here. We just resolved it to the downside. So if we break this pivot that I just showed you here of 148.27, you could see at least 140. Which would be another $100 lower in gold.
that chart is the most perfect example of the trend is your friend. You absolutely cannot fight the tape on this one. Let's take a look at the oil ETF, USO. That one's been in a significant downtrend as well, whereas natural gas, it's actually made a really nice move up over the past month.
Yeah, well, I would say oil at 92 is good. Oil below 85 is better.
Right
now, it's just really just hurting oil stocks and commodity-related stocks. It's not really helping the consumer yet. But the trend has been down ever since it's broken a few key support levels. And now coming into like 92-ish, I think, again, some traders will try and cover. And yes, it's good that it's lower, but I think at some point it would be much better if it can get below 85, even get below 80, then we'll see some type of money going back into the consumer's pocket. If you look real quickly at the chart, you will see for a trading vehicle, I don't think a lot of my guys have been really trading it because the moves there aren't so big. We're coming into some, actually just broke below another support level. So I would say on the USO, if you're trading it, you do have a level right around 34. It's below all these moving averages. So if it tries to bounce, I think there's going to be a lot of resistance right around here. Let's hope that this gap that's been controlling this downside move continues, because I think that overall might be bad for some commodity stocks, but it'll be better for the overall economy and the market.
All right, guys, we're going to jump into a quick commercial. When we come back, we dive into the trenches.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
All right, welcome back, everybody. We're going to dive into the trenches and look at the retail space. Surprisingly, consumer discretionary has really led this market when everyone's been concerned about the strength of consumer spending. We're going to take a look at Priceline. April 24th, Scott and I, this thing was trading at 680. We mentioned that Benchmark took the target up to 750. It went just up to 760, and now it's pulled back in. That's been an incredible move in just 3 weeks.
I think finally the shorts are starting to make some money here, and I think that they're smelling a little blood. And after the report that came out that wasn't robust to support this massive PE in Priceline, I think technically it's going to go lower. If you look at the chart here, you will see that in this upper range, okay, this was a nice technical breakdown. When it broke below, retested, and then pow. On earnings, obviously, some people take options, some people take stock. I did nothing with it, but my guys started to trade this short once it broke below this 680. So the longer it stays below 680, just say 690, these moving averages, I think the higher probability that you could short this thing all the way down to about 620, where you see a gap that comes into play from late February, and that also comes into the 100-day. So I would say if you're an uncommitted short, stay short up until about 690, but I do think that below this level, 620 is in the cards.
Moving along to one of its competitors, Expedia. Typically, Priceline is the one that leads this group, but this one's been showing a little bit of strength and holding up decent after earnings.
This is one of my favorite patterns of the market because anytime you see a pro gap into earnings and it continues to hold it, that shows you pent up power. And if you look here at the chart of Expedia, it doesn't look like the market, right? You had a huge gap up, a lot of people were short and trapped, no one was really expecting it, and now we've been going sideways. You have a nice tight pennant type pattern as the market's been coming in. Expedia is not coming in, so I do think if this market starts to get going, you could see a nice tradable move above this area. I would say above, I'd say 42.30 to about 43.90. That's your pivot, and this could be one of the first few stocks that gets some momentum if the market changes its composure and we can get a bounce for more than a few hours.
Moving along to Amazon, this is one of those names when it reported back in December just could not get out of its way, but it's been showing some relative strength. And Scott and I spoke about this in the Morning Call Express. In terms of the retail model, we've got the Amazon world, the online world, the luxury names, and then the department stores. And this has been showing some really nice strength coming out of its earnings.
Well, it also gapped up in earnings and held the gap. Not like some of the other stocks actually filled the gap and showed weakness. So if you look at the chart here, to me, I was not an Amazon bull at all. It looked horrible to me. It wasn't trading well. All of a sudden, earnings came out. Now look at the size of this earnings gap. What I like about this is you have points of reference. You have the low end of the range, which is around 220. Then you have the high end of the range, which is 230 to 232. Yesterday, it tried to break above it, but if the market's not ready to start getting going or getting on its high horse on the bull side, it's not going to let stocks like an Amazon break out. So I would say when Amazon starts getting above 230 and 232 and actually could hold it and breakouts start working, then we'll know we're in a little bit healthier environment. So as long as it stays above this 220, I think it's in the cards of being a leader once we start getting a little bit more positive composure in the tape.
Speaking of leaders, let's move along to the department stores. Macy's, this has been the best in breed. It's been the darling within the department stores. You've got that nice dividend there, and it's performed pretty well.
At this point, though, I think
it's a little bit done.
Well, you just have to have high-level stops and low-level stops, and trends are always great until they break. And if you look here at Macy's, I'm not saying the trend is broken, but if you look here at this uptrend that was intact for most of the year, it broke right here. Okay, so not game over, but then also once it traded below this key support, it also lost some technical strength. So if you're a short-term guy, this was an exit and this was an exit. Right now, it's below the 100-day. I'd say the longer it stays below this 39, the better the chance you could see a move down to this 33 area or 34 area. So at this point, I think it's an avoid. Hopefully you sold some into this massive move. And if you did, I think you'll be able to buy a dip probably closer to 34 to 33 in my opinion.
All right, let's wrap that up with JCPenney. What a mess that quarter was yesterday. I wonder if it was one of those kitchen sink quarters. Missed on every metric. They took away the dividend. You wonder, are they alienating their core customer? Is that model completely broken? Yes, the Apple model works for iPhones, iPads. What's the other one? iPods. But when you're looking at a major department store with clothing, home goods, and everything else, does that model necessarily work? I wonder if there's a one-time quarter thing or if it's completely broken.
Well, I think they're a little lost in translation.
Right.
They just don't do anything well. They have no identity, like you said. So when that happens, no one says, I'm going to JCPenney's for this.
Right.
Because they don't know why they're going there. They might as well go to Target. They might as well go to Walmart.
Or what are the Amazons?
Yeah, or there you go. So if you look at the chart here, though, the street wasn't really expecting much. You had the excitement when the guy from Apple came over, pow. But since then, it's been coming lower, and it's been holding at decent support. So on this news, it's down about $4.50. It's going to be coming into a nice size support. So I would say if you want to give JCPenney's a chance, first of all, I would not be shorting into this 28 area. I just think that you missed your opportunity. I think buying it versus the 15-minute low could be good for cash flow. I think it's going to be on my trader's radar, so if you want to tune into the radio. So I think it's a better buy here. If this 28 doesn't hold, just make sure that you know that this 24 area could be seen. So if you want to leg in, maybe tier 1 long here, tier 2 there, if you want to take a long-term approach with JCPenney.
All right, let's move into quick hits for some quick cash. I know the T3 traders were very active, and Visa and MasterCard a couple of weeks ago when they reported really nice. Let's take a look at Visa and see how it's trading since then.
Well, I think at this point, they're getting to almost everything, so you have to be a little careful. Like we said, upper level stops and lower level stops if you're uncommitted. Take a look at the chart of Visa. I know that Evan is actually short this, and he thinks that this 115 is going to break. So to me, I think you have a constructive trade here. You have this wide range bar that has not been able to be reclaimed. So as long as it stays below this 120, I think if you want to stay short, which has definitely been tricky for Visa, a trade below 115 gets you a move to about 128.84, which would also be testing this gap from February. This to me still is a strong stock. This to me is still a macro hold if you're holding macro positions for a while. But again, for this major move could see some corrective type opportunity. So as a short-term trade below 115, you could see a little bit of juice for the short.
All right, let's take a look at Apple. We're looking at some new support levels here.
Yes, Apple has been a focus. It's always a focus.
For everybody, right.
It's always a focus, but recently, it didn't act well with earnings. And I tried buying this thing. We talked about it on the call a lot. I thought perhaps it would be very similar to the last earnings, but it wasn't. The last time it came out with earnings, you look at the chart here, it had 4 days and then turned up and ran. This time, you had a big earnings gap, and it didn't turn up and run. It filled the gap and showed no power. So to me, it's been more of a sell. I've been trying to short, and it's been working. It hasn't been that easy. So today, it's up a few dollars with the market. I would say if you're short, 563 is your stop. But if you're looking to add, I think this will be a good barometer for the market too. If it starts to trade below yesterday's low, which a lot of traders are probably going to fade this open, below 551.75, the real next level is down here at the 100-day around 525. So if we break this and move lower, I think we'll finally get some speed to the downside in the market. If they keep Apple positive and they don't let it break, we're going to have the same type of churny, drippy action, which we've seen.
Well, it's amazing like what we've seen with Apple and in Amazon, how from the last quarter when they just reported in December, how they've completely flip-flopped. And the charts are almost like the inverse of each other. Let's move along to another big tech name, Google. You've been playing this one really well all year.
Well, I actually haven't been trading it well. As far as trading
Going into the year, you did though.
Yes, okay, so I appreciate that. The fact of the matter is it hasn't really been a good trade at all for traders. As an investor also, the patient investor is getting rewarded because every time they've missed on their quarter, you've been able to buy the 200-day. And it happened again. If you look at the chart here of Google, you will see that it's giving you support. Here, they missed, held the 200-day, nice buyable support, which we did say, came all the way back up, boom, they missed, held the 200-day again. And at this point, I think finally there's going to be a trade set up here. I drew these 2 arrows because it's been in this pennant time pattern. You never really know which way it's going to break. I think if it starts breaking to the upside above 615, that will show you some health in the market. And I think then finally a trade with power, could be good for a guy like myself on my floor because, at least it's calculated. You have resistance. You can get through it with volume. Then maybe it'll show some leadership. And I think a lot of people are talking positively about Google.
Right.
Because like Facebook's going to open up with probably a 200 billion valuation. It's getting valued at 100 billion around 38. So if it opens at 70, that's going to be 200 billion. And that's the valuation of Google. And think about the difference in business models and the stability and the proof that Google has versus a Facebook.
Moving along to a name I know you have traded well, the casino names. When I think of Red Dog, I think of the casino names. You have traded Las Vegas Sands and win really fabulously well. Let's take a look at LVS.
Well, this stock technically has acted very well. I put a target 62 to 64, had a nice channel, got there and also gave you a sell signal, which is all you can ask for. And if you look here at the chart, before this big melee to the downside, this was your little outside day. This was your buyable pattern right here above 50. Then I think we called another nice trade right here. Kramer put it on us off the charts when it went above this 52.40. And then it changed right there. Small sell signal, data take notice, and then this was your way out when this broke. And then this 56 area was also big, and that broke. So now the question is, can it hold the 200-day? I am flat LVS. I've been flatted for this entire move because it hasn't acted well. But now I'm going to look to see if I can get a cute type buy. 80-20 trade, 48.60 is the pivot. Maybe it breaks below, comes back above. This will be one of my focus for some type of cash flow trade because I think it's been too beaten down. If you sold the strength, this is the spot to buy. But again, the casinos just haven't been acting well.
Let's wrap it up with JP Morgan. I think this is an important one that we need to spend some time on, not only from a technical perspective, from a fundamental perspective. I think this is a fantastic opportunity to get in. Fundamentally, nothing has changed with the company. This could be a great opportunity for people. But the day when the news was announced, I think it was last Thursday, I had people calling me, do I sell my stock here? Do I pull my deposits? I absolutely don't think you do. It's not a regulatory issue. They were on the wrong side of the trade. That doesn't mean you need to get more regulators involved. It's more of a PR nightmare. And I think like Scott, when you say you need to let the news be digested and let the chart sort of take control of this thing, this is a great time to get involved as far as I'm concerned.
Well, if you sold into strength into 44, 46, I think you have the opportunity and the luxury to buy back between 34 and 36.
Right.
And as you said, all my funds are at JP Morgan Chase. I am not pulling a dime out of the bank.
Same here.
Yes, they had a bad trade and it might even get a little bit worse and it'll affect their earnings. So it could pressure it for a little while, but I'm sure they can get back on course and the banks at some point will be a buy again. So you should turn to this one. If you look at the chart, here's where I would look. If you sold it into this strength or you sold it right before earnings because you don't take stocks into earnings, you saved yourself a pretty big down move. So at this point, you do have a new channel that could be developed here. So this, if you're flat, I would say get into tier 1 within this zone. you now have a tradable range here. The low here is 35.76. The high here is 37.14. So be in tier 1 here. But if it breaks this area and you don't stop yourself out, realize you're going to have to buy a little bit more, and that could be down to 34. I think 34 is very, very compelling. It all depends. If we break this area, then you'll see the market also trade down. So I would say for Apple and JP Morgan, I've been keying on this. If JP Morgan doesn't break this recent low, it's going to be hard for the market to go down. And if Apple doesn't break yesterday's low, it'll be hard for tech. So watch those two while you're trading the market. And I think both of them will have long-term opportunity besides just trades.
All right, guys. Keep it nimble, keep it nice and tight. Don't forget, actually, Scott is going to do, I want a quick programming note, going to do a special series on Facebook where the IPO comes out on Friday, and also how to trade these new issue names. Don't forget, every day at the end of the day, Scott wraps it up for us on the charts, real money, options, profits, and T3Live.com.